My name is Victoria Keane, and I'm working in the Local Government Capacity Centre within Homes England. And I'm here to welcome you to the Housing Market Insights session for the North and the Midlands. So next slide, please. So this is the mission statement of the Homes England Local Government Capacity Centre. And this summer learning programme is brought to you by the Capacity Centre. And this tells us, or you, who we are and what we do. We've launched the centre following extensive research and consultation with you across local government and with a whole range of partners to determine where authorities need support and how this can be best delivered. We look forward to hearing from you in terms of what we can do in the future. So make sure you get involved with the survey and the polls at the end of the session. Next slide, please. So this is the agenda for today. So I'm delighted that we've got some Homes England experts to talk through the housing market insights for the North and the Midlands. We're going to hear from Fionn, Fran and Imran. And then hopefully we'll have time at the end for Q&A with Rory will be back to chair that. And then we'll get some final thoughts and feedback. Next slide, please. Okay, so let me hand over to Fionn, who's going to take you through the introduction to the session. Thank you.
Hello everyone, and thanks very much for asking us to come and do this. I'm going to talk about the macroeconomy, where we are now, where we've come from, and the things that we might face in the short term and why they're really important. And then my super able colleagues, Francesco and Imran, are going to pick up from me. Fran's going to talk about the housing market, how the macro affects that, some of the things that we're seeing, some of the differences that we're seeing and have to face going forward. And then finally, Imran's going to get his crystal ball out and talk to you all about what the forecasts say, where we might be going over the next few years and some of the risks and challenges that we're going to face. So next slide, please. So this is a real quick summary about what I'm going to talk about. We've come from the pandemic, out of the frying pan. Are we now going into the fire of inflation? We know the UK economy has more or less recovered from its pre-pandemic levels, and that's largely been due to the success of the labour market. Brilliant, brilliant, brilliant. We couldn't have expected it to do so well. But are we now going into the fire rather, with that perfect storm of inflation, higher bank rates, public sector finance challenges, low consumer and business confidence, and now, of course, after yesterday, some political uncertainty. Next slide, please. So starting from where we've come from, now the COVID recession was the deepest recession we've seen since the Second World War. We've more or less got back to where we were, which is great stuff. And I said the labour market has had a lot to do with that. But we're not back to where we would have been. So don't think that everything's just fine. We're about 5% smaller as an economy than we would have been if things had carried on the way that they were. We need to catch up now, need to catch up that growth, but we're doing that from a bit of a step back. But we're also facing some structural differences because of COVID and because of the way that we've changed the way we work, rest and play. And we need to deal with those too. And we're facing some other challenges. Next slide, please. So I mentioned that the labour market has been a wonderful saviour. The furlough scheme was a tremendous success. And coming out of that has been much, much better than any of us economists thought it would be. We thought we would be much more scarred in the labour market as a result of that, of those lockdowns and the loss of businesses. But we've done very, very well. It was a very, very expensive policy, but it's done very, very well. And we might have to pay the price for some of that later. But now what we're seeing is the highest number of paid employees that we've ever seen. The series only started in 2014, but given that the population's increased and so on, it's a really encouraging number. And in the right-hand chart, we can see that unemployment has fallen almost to the levels of pre-pandemic, and that's great news. And we've got vacancies at their highest ever level, more than unemployment. So it almost looks like we've got some jobs to spare. So that looks like a fantastic position for the economy to be moving forward from. There are some things that have changed a little bit in there that those stats and those charts are hiding. One of those is that while we've got more paid employees, lots of people who are self-employed have either moved out of the labour market or they've become employed. The other thing is that older people tend to have moved out of the housing market, those in their 50s and above. They've decided to make a lifestyle choice and move out of the labour market altogether, and that flatters some of the unemployment data. But also about 500,000 migrants have left the UK during COVID, and partly because of COVID and partly because of Brexit, and that helps to improve the situation too. But it's a great strong position for us to be going into now. Next slide, please. Just as those two charts can disguise some of the underlying things, so too can just looking at overall UK levels of unemployment and employment. And this left-hand chart just shows you quite how different it is across the country. And largely it's the case that unemployment and inactivity are lower in the wealthier south than they are in the Midlands and the north. Now, the East Midlands done very well, very low level of unemployment there, and but still quite high levels of inactivity. But it does show you that there are different challenges across the country relating to the different skills that are needed in different parts of the country, and there's different industries that are there. So that makes a big difference. So you're never going to get it exactly the same, but it does make different challenges, and particularly for people in local government who have to face those challenges in a different way in different regions. But I mentioned at the very start that we have some structural changes as a result of COVID that will affect the way that we work and play these days. And this chart on the right shows us how many people, or the proportion of people that generally have been able to work from home during the pandemic and are perhaps continuing to work from home now. And if you look at that chart, you can see that the predominant workers from home have been in the sort of wealthier south and up the middle of the country. And if you look at a map, which I sadly haven't put in here, silly of me, of the highest earning people, then you can see that they tend to follow almost exactly that same pattern up the country. Now, that tells us something very important about the distribution of workers across the country and how they can work from home and working from home. And working from home makes a big difference, because those wealthier people who've been able to work from home have had a double plus from them throughout COVID. One, that they haven't had to spend on transport costs to be able to go into the office, and two, they've been able to save that money that they would have spent on transport and buying their sandwiches in pret-a-manger. So that's given them a bigger cushion than they would have had if they'd have had to go into work. And that's given them a better cushion to face what we're going to be facing in the next few months with inflation and so on. But on the other side of it, if you see the more rural areas and the less well-paid areas, those people tended to work more from their old places of work, or they've had to go into work. They've been driving buses or trains, or been health workers and had to go into the office, as it were. They haven't been freed from those transport costs and those additional costs, and they've had less chance to save, and they've tended to be on lower incomes too, so they've had less opportunity to save anyway. Now, that's important for the distribution of wealth in society, but it's also looking at the distribution across the different areas of the country. That has a big impact on the sorts of things that you will face, and the structure of local businesses. If people aren't going into work in the centre of towns, what does that mean for business rates? What does that mean for the sorts of planning that you might have to look at? And also, of course, for the transport planning and all of those sorts of things. So it's one of the structural things that's left with us from COVID. The next slide, please. So now we've gone from where we were, coming out of that and some structural changes we faced. So out of that COVID frying pan and into the fire of inflation. Now, we've seen inflation increasing to 9.1% is the latest number. That's the highest rate it's been in 30 years. And you can see how quickly that's changed. That's been quite a shock to our economy. But the important thing also again about distribution across the distribution of wealth of people across the economy is that those increases in prices have predominantly been in things that people can't avoid spending on. So gas and electricity prices, petrol prices, which are now at the highest level at the pumps than they ever have been. And now we're seeing food prices beginning to increase more rapidly. Now, that's really important. That's really important for the economy going forward. partly because of the inequalities that I just mentioned. Poorer people are less cushioned from that, but it's also important for the rate of growth. We're an economy that it depends an awful lot on consumer spending. About 2/3 of our economy is driven by consumer spending. So if the prices of the essentials are going up, we've got less to spend on other things. So that's something that takes away from our opportunity to recover. And the difficulty that we're going to face is that we're going to see more of this inflation coming through. In the autumn, we'll see a rise in the energy price cap again, and that will again push up those housing and household services prices. Sanctions in Russia and the war in Ukraine, that's only going to get worse in terms of trade, in terms of not just fuels, but also food. And that's obviously that's an essential for all of us. And transport too, getting around, but also transporting things around, particularly, for example, food that we need. So next slide, please. Now, inflation and higher prices are, there's something that we face, but it wouldn't be a problem if our wages are increasing at the same rate or even faster. We'd feel wealthier. But that's not the case, and that would be quite a dangerous place to be in terms of the structure of the economy. But wages are falling behind, and we can see from this chart that if you take inflation into account, then actually wages are falling. So the purchasing power that we have, what we can buy with our money, is less now than it was a year ago, and it has been for a few months. So the combination of having less to spend on other things means that there's less of a boost from consumers into the economy, and then that slows down the rate of growth. So why can't we increase wages when inflation is increasing? Why can't we just reduce that burden on people by giving them higher wage higher wage settlements? And the reason for that is that fear of embedding inflationary expectations. And you might have heard or remember hearing Andrew Bailey, the governor of the Bank of England, saying, we do urge you to have some wage restraint. And it did sound slightly patronising at the time and quite difficult for people on very low incomes. But his reasoning behind that was, if wages start to increase very quickly, then that tends to be self-fulfilling. You have higher wages, people can spend a bit more, companies will be able to will want to try to recoup their profits that they may have lost, so prices increase further, and you get to a stage where companies can't continue to do this, and unemployment will begin to increase. People begin to lose their jobs, and then you end up in a position when you've got high inflation and you've got getting rising unemployment, and that would push the economy into a recession. So it's a very fine line to tread. You've got to be very careful that wages don't get out of control and push inflation up further, which would mean higher interest rates in the long run anyway, which would be more pain. So the next slide, please. Now, this is about public finances, really, but the example I've chosen here is public sector and private sector pay. The public sector payroll is a big part of government spending, and it just shows here how public sector pay is growing much less quickly than the private sector, and it has been for some time. But the difficulty for the government here is if it tries to respond to public sector pay and the cost of living crisis with very generous pay rises, that's great. That's really good for people who've been held back for a long time. But the issue that it has to consider is, one, spending more on public sector pay means there's less to spend on other public services, which would obviously hit local government in lots of ways, but also would hit welfare, would hit the NHS spending, and so on. But probably more important from the pay point of view is the signal that it will produce for the rest of the economy. If public sector pay is increasing more rapidly, then that gives almost a green light for wages elsewhere to increase in the economy, and then you might get into that rather nasty vicious circle of a wage price spiral. But obviously, public sector finances aren't just about pay. There are other things going on: increased welfare spending, trying to help the cost of living crisis by giving some subsidy and some help to people with fuel costs and with council tax and so on. Those things are very welcome for the poorest in society. But government also is facing, in a higher interest rate environment, that it's got to pay more interest on its debt. So all these things together, I mean, it's a more a tighter situation for the public finances, and that's going to be impinge on all of us, both through welfare, through local government funding, and the more they spend on one thing, the less they've got to spend on other. We'll have a new chancellor now, as of today, I suppose. We'll see what his choices might be, but I don't think we're going to be seeing a great deal of public sector spending going on. So we've got some tight things going on ahead of us in the next few months. Next slide, please. And I've said a tiny bit of thing about why it's very risky for a wage price spiral, and why inflation becoming embedded is bad. But I'll try to explain a little bit more about how bad that can be for the economy. So I mentioned about consumer spending being 60% of the economy. That's a huge proportion, bigger than anything else. And so if you're not spending in the economy because inflation is increasing, you've got less money to spend on other things, which means that the things that you're not spending on, those companies aren't doing well. And then you'll start to see those companies going bust. You start to see unemployment picking up, and you start to see people having difficulties with maintaining the standard of living that they require. So ultimately, if you've got lots and lots of inflation, consumer confidence drops, consumer spending drops, and then you end up with some more unemployment and people falling, and the economy falling into recession. That's the consumer side of things. But the other thing that's really, really important for our economy and for growth is business investment. We need businesses to invest, to improve our efficiency, I should say, to make us more competitive in the world, and to help the economy grow and get back to where it was and overreach that 5% that we're missing already at the moment. But when you've got inflation, that makes it very much more uncertain for businesses. They don't know what the demand is going to be like for their products in an inflationary environment. They also need to pay an awful lot more for funding. They need to borrow too to get their funding. And that makes it much more difficult for them too, and their confidence is reduced, and that gives them a bit of a disincentive to invest. So you need a stable economy with stable inflation, stable prices, and when inflation is moving out of the way, then that's not good for business investment either. And neither of those two things together, consumption and business investment, neither of them are good for promoting the growth that we need to get back to where we were and to recover. Next slide, please. Bringing this closer to housing markets, which are close to my heart and to my colleagues' heart and Homes England, from a sort of housing market perspective, if we look at individuals in the housing market, we know that it's very, very difficult for first-time buyers at the moment, and that has obviously an implication for the amount of affordable homes that we build, the need for Help to Buy, for example, the need for social housing, and getting a deposit to buy a house has been the biggest hurdle. With inflation, you can see in the left-hand chart here that inflation just erodes the value of savings. It really hates savers. So if you're saving, you've got £1,000 at 2% interest a year, and inflation's at 5%, the value of your savings after 10 years is worth just about £725, whereas in nominal terms it's over £1,200. You're just not able to get there. And with house prices increasing with inflation, you're just running to standstill, or even less than standstill. So it's really bad for savers, and those from fixed incomes, pensioners and so on, they all suffer as a result of inflation. But for borrowers, if you're already in the housing market, you're actually in a great place. It loves borrowers, does inflation, because it erodes the value of your debt. So this chart on the right-hand side is showing the debt servicing burden. So if you take out a mortgage and you're able to pay, say it takes up 25% of your income when you start out, with inflation or wage rises, say at 2%, because inflation is very low, then your debt burden doesn't erode very much throughout the 25 year of your loan. Excuse me. But if your wages are increasing at 7.5% or 10%, because inflation is much higher, then you can see that burden drops really rapidly, and you get richer. You get much richer, and your burden is much lighter. Now that's great if you're in there, but it does mean that people tend to, in inflationary times, if they can, they'll want to increase their risk by increasing their leverage. And that's a very risky situation when inflation is high, because the economy could turn into recession and you get a very difficult position for people in own occupation. And that's what happened really in the 1990s, early 1990s. Inflation was high, interest rates increased very rapidly. We went into recession, people lost their jobs, they geared up very much, and they were in a very bad place, and we had negative equity. But the other thing relating to the housing market and inflation is to do with renters as well. So renters, lots of them are saving to get into the housing market, and they face the issue with savings being eroded. But also they don't have the opportunity to save more, because rents will also increase with inflation, and so their burden of their rent, if you like, is also keeping up with inflation. So they have less opportunity to save. And of course, all of these things together, that increases the need for provision of housing at affordable levels. And that's that's important to all of us who are listening in or participating in this call. So next slide, please. So we know inflation is increasing really quickly. We know that it's really bad for an economy, and it's not something you want to be sustained. But what's driving inflation now, and what can we do about it? So it's a real big shock to the economy, but it's not something that we've driven ourselves. The shock of inflation has come from outside of the UK, which means there's very little that the Bank of England can do just at the moment with interest rates. It's the only tool it has, but there's very little that it can do. And we are suffering significantly more in terms of the price of fuels. And this chart shows you why. One, the price of oil has increased really rapidly, that you can see on the left-hand chart there, just quite how steeply it's increased. But because our currency has been falling against the dollar over a long period of time, that means that we've also faced the currency bat on there as well. So we have to pay more in sterling per barrel of oil, because oil is priced in dollars. So we get a double whammy there. So we're going to see this carrying on for some time, the high price of fuels affecting the UK economy, and that's affected by our currency. And if we're in a position where there's less confidence in our economy, then we're going to see our exchange rate falling further, and that affects import costs as well, which could also have implications for inflation. But the other things outside of the economy, outside of our domestic economy, that are causing inflation, of course, are things like COVID. Still in China, there's zero tolerance for China, for COVID in China. It means that supply chains are still disrupted. Shipping isn't happening. Many of the goods that we buy from China aren't coming out as quickly as we'd like. There's also the sanctions as a result of the war with Russia and Ukraine. Now, obviously, that's affecting trade, and it may have implications for Russia withdrawing its gas supplies, but also particularly in food. Ukraine is a big supplier of grain. It's a big supplier of cooking oils, and with sanctions and with the war going on, that's very much more difficult for those things to come through. They have a big impact on the price of food, and that's something that's going to be hitting us again. These are all imported shocks. As I said, that the Bank of England can do very little with its tool of interest rates only. Can we have the next slide, please? So this is the last thing I'm going to talk to you about is interest rates. And I say it's very difficult for them to do anything with interest rates, but the Bank of England has to look to the future. It can't do very much about this imported inflation, but what it has to think about is what this imported inflation will do for our expectations of inflation in the future, any wage price spiral. So using interest rates now, increasing interest rates now, sends a message that it's really serious about this inflation. It's not going to tolerate it. And if anything starts to happen in our own economy, domestically generated inflation through that wage price spiral, if it picks up, it will sit on it very, very quickly. So we can see interest rates are beginning to increase now, sending out that signal. But it has a very, very difficult job to do. It's a very, very hard job to know just where to place that. If it does too much too soon and raises interest rates too quickly, too high, too soon, it risks crushing any growth potential that we have in the economy. It will increase, obviously increasing interest rates will affect business investment. It increases the cost of it and so on. So it has to be very, very careful about that. But if it leaves it too little too late, then it risks that wage price spiral being capturing speed, and then it would have to do more with interest rates later, and that would push us into another recession. So it's a very, very difficult line to draw. And if you look at what the markets say about things, and you hear it in the newspapers that the markets think interest rates are going to increase really, really rapidly, it doesn't necessarily take into account the thinking that the Bank of England's that's going on in the back of their heads about the signals that it's sending and about how quickly it should raise rates to keep growth potential there. And this chart on the right-hand side just shows you how market expectations of interest rates have increased rapidly. But the grey line, which is the forecast for a forecasting house that we use called Oxford Economics, that's taking into account the balance, if you like, of between growth and inflation. And while the markets might think interest rates are going to up to about 3%. If you overlay on that the risks that the Bank of England might face in doing that too quickly, and we think that the rates will settle at a rate much lower than that, around 1.75 to 2. So I think the truth is we've got a difficult time ahead of us. Inflation is here for a little while. There's lots that we've got to face in the cost of living crisis, and we've now got political uncertainty on top of that. That's all I'm going to say about the macroeconomy. I hope I haven't said too much or frightened you, but I'm going to pass on to Fran shortly now, who's going to talk to you about the housing market, and he'll have much more interesting things to say. I'm sure you'd agree. Less gloomy, I hope. Thank you.
Thanks, Fionnuala. I'm not sure what is going to be more interesting, but to an extent it is going to be less gloomy, although I do love a bit of macroeconomy. Good afternoon, everyone. I'm Francesco Mellino. I'm a senior economist in the research team at Homes England. And no, don't worry about clapping. Thank you so much. It's too kind, too early. And if the clapping was for Fionnuala, you'll get her again at the end for questions. So do make sure you ask questions at the end. And if you can go to the next slide, we'll jump right in. Because we're talking about housing market, and so what better place to start than not looking at house prices and how they have changed in the last few months and years. This is not my first slide for house prices, is it? I can start from this, but this is not my first slide. Anyway, maybe there was a previous slide than this. Yes, I like this one much better. This is the overall indices of house prices. And as you can see, there are 3 lines in this. A line from Rightmove, a line from Nationwide, and a line from the ONS. So these are 3 different indices, and you will see them cited in the news almost interchangeably, but they measure slightly different things. So Rightmove, as you may expect, they measure asking prices, so whatever gets published on their portal. Nationwide measures the mortgages that they will process, whereas the ONS measures the actual house prices based on the transactions that take place. And the reason why at Homes England we look at all 3 is because they give us slightly different information about what's going on in the housing market. And so Nationwide, by its nature, is excluding cash buyers, for example, while Rightmove is focusing on asking price. But as you know, there are times in which asking prices are difficult to achieve, and other times where actually people have to go above and beyond asking prices. So it's just important that when we see this data published in the news, and when we then look at the data, we're able to see if they kind of tell the same story. And you can see that from 2020, they have broadly been telling the same story. So they've been going up quite significantly. They're now all expecting house prices to have gone up 10% in the last 12 months, which is a really, really substantial amount. However, during this section, we're going to disaggregate what this means, because this is an average increase. But as we can see, we can break it down in many ways. And if we go in the next slide, we can see the first way in which we can do it, which is by looking at different types of houses. So if you could get the next slide, please. Thank you very much. So you can see that the increase in house prices, especially since 2020, but even beforehand, has been mostly driven by a strong increase in the price of detached and semi-detached houses, as opposed to flats. Flats have increased, but much less so. And there are a number of reasons for it. First of all, we should start to look at the trends in flats in general. So the reason why prices in flats have been so low is the problem with cladding. But if you can see, the trends in flats really starts going down quite fast in 2017 after Grenfell and with cladding. But at the same time, after the pandemic, when everything picks up quite quickly, we also have to remember the beginning, the map that Fionnuala shows really is not, the pandemic wasn't the same for everyone. There were different segments of the population. I'm afraid terraced house it would be in between. So you can see terraced houses, David, in a line in between. There were just too many lines for this chart, and it wasn't telling much more. So terraced house, a bit more popular than flats, not as popular as semi-detached, as you would expect. So I was saying there are different segments of the population that have been impacted by the pandemic, and there are some segments that have been relatively better off. Their savings, their purchasing powers hasn't changed, and their savings have actually increased. Those tend to be the segments that could already afford a slightly bigger house, slightly bigger houses, and tend to be detached and semi-detached. So the segments of the population that have been kind of sheltered from the pandemic have been able to continue to transact in the market and to buy and demand detached and semi-detached houses. On the other end, the people that were maybe on lower wages, or maybe even people that want to live in cities, there was just less demand for city living early on and during the pandemic, and people that would have usually have entered the market on a flat were just in a worse position to do so during the pandemic. And that's why the demand for flats is so much lower than the demand for housing. So it's not just the cladding, it's not just the demand, it's not just the preference, it's just they really have been separate markets, and the cohorts that go and work in this and shop in those markets have had quite a different pandemic. So the most important thing, though, is to remember that these prices are going up across the board on average, and that's because the demand has just been outstripping supply basically for every type of housing. And this has been happening across England, across every house type. And if we go to the next slide, please, you can see that this has been happening in every region as well. So in the last 12 months, for which we have data from the ONS, you can see that house prices have increased by at least 10% in every region in England other than London. And this is a very, very large amount by recent historic standard in the last maybe 10, 15 years. This is very rapid. I always like to present this as alongside absolute prices as well, because whenever we say, oh, everyone has been growing at 10%, it makes it look like it's still a single unified housing market, which it is not. Even though we're looking at averages, and averages kind of reduce the outliers within every region, it's very important to show that a 10% increase in Northeast is not quite comparable yet to a 10% increase, for example, in the east of England, which is more than twice as much. And London is a bit of a story of its own. So even though London has been growing at a lower rate of increase in absolute terms, so the absolute amount of pounds that houses have increased by is higher in London than everywhere else. And the other regions are catching up, but it's going to be a long way if London continues to grow at that rate and starts from such a higher level. But this is just to show there is great variability in house prices. And this is something that has happened ever more so since the 08-09 financial crisis. So something I would like to show is how that has affected affordability across England in general. And I have a little bit of let's just say a story about this. So if we go to the next slide, you can see this story seen in 3 maps. The first one is from 2003, and then 11 and 2021. So the colors in this map are shaped by the affordability ratio. The affordability ratio is a ratio, so between the value of housing and the amount of local earnings. So if the value is 10, and so the color in this map is red, it means that the median house in that local area is 10 times larger than the local salary. And this goes back to questions that we had earlier in the chat from Emma, talking about how are people expected to save for housing when it's getting less and less affordable. Well, this shows it visually. This shows the trend visually of how it's getting less affordable, and now much more in terms of the absolute value of the house. How that has translated spatially. And while affordability, and as we were seeing the absolute value earlier, it seems to be on paper just like a London story and a wider South story. You can see that there are many examples of very expensive places where now houses are as a median value. So there are even worse examples, are much more than 9 times higher than local salaries, even in the North and in the Midlands. So this is very much not a London story anymore. And the trend is really going one direction only. You can see Trafford and Greater Manchester there are catching up as well. So this is mostly driven by demand, but to another extent, it's also been driven by the fact that in the last 10 years, as Fionnuala touched upon, interest rates haven't been particularly high. And with low interest rate, people are able to borrow more, and that pushes the demand and the price of housing further. But I just wanted to show this as a visual story of affordability is not necessarily just a southern issue, although you would argue that in the south it is an endemic issue, and in the north it is an emerging issue for the greatest part. If I can go to the next slide, please. And this moves quite nicely into what the other aspect of what determine what affordability is for people on the ground. So one is the actual value of the house, and on the other end is how much it costs to borrow to get the house. So that is the rate of mortgages. Mortgage rates have been historically low, and they still are historically low. They jumped a bit during the pandemic, but for people that had relatively larger deposit, they remain very low. And that is one of the major barriers to house ownership, to home ownership in the current moment, is the fact that once one can get the larger deposit, is relatively cheap to own a house, and we'll touch upon this in a bit. But what I like to show is the fact that since the Bank of England has started raising rates since December, mortgage rates have started increasing quite significantly and quite fast. They've picked up quite fast, and what this means is that for people that are taking mortgages out now, borrowing the same amount of money is going to be increasingly more expensive, and this just means that something has to give. It's either that they will not gonna stretch themselves as much, or that they won't be able to do it, and so this will, by its nature, remove the pressure or a part of the pressure on house prices. Because if people can only pay as like a certain amount on their mortgages, then increasing rates will just necessarily push demand down. If we can show the next slide is a bit complicated, so I'll spend a bit of time explaining it. But basically, these are the two factors that explain the affordability of mortgage repayment. So if we park for a second the idea of having a deposit, which is challenging to put together by itself, savings is already challenging. But say you manage to save enough to get a mortgage, then what affects your mortgage affordability is how large this mortgage is, and that is the loan to income ratio. So how large your mortgage is compared to your income, that is the x-axis, the horizontal axis, and what the rate of your mortgage is. So that is the y-axis, the vertical axis. You can see here different quarters of different years are mapped into this chart, and it just shows how affordable it is based on how in debt households are and how expensive mortgage rates are. And this just shows that right now, if you can see, like the latest data we have are on Q1 2022. And mortgages, for those who can afford those, are relatively expensive by historic terms. They're just above 15-17% of disposable income. And there are assumptions in this saying that it's a 25-year mortgage. But they're relatively affordable once we can afford one. However, we're now in an environment where the rates are increasing. And so you can see this red line in the future going basically vertically up to less and less affordable places in this chart. And as we move vertically, it will become less and less affordable for everyone. There is a reason why, though, that Homes England were not necessarily worried straight away about this, in terms of this becoming an issue straight away, and these increasing rates that has been happening since December to become a problem for the housing market straight away, for the housing market to crash straight away. That's because mortgages, for the larger part in the last few years, have not been linked to variable interest rates that are directly affected by the Bank of England, but they've been on fixed terms. And if you go on the next slide, you can see the proportion of mortgages on fixed terms and variable. The variable ones are the black ones. So the black ones, I think as of late, there are about 2 or 3% of all mortgages in England are on a variable rate. That is a very low amount. And that just means that while interest rates are going up for everyone who has to take a new mortgage now or has to remortgage their house, everyone who was already on a fixed mortgage rate of over 5 years or up to 5 or up to 2 years is sheltered by these rates, these rates for at least the next maybe 1 or 2 or 3 years. And that just means that the shock is not going to come all at the same time, and the shock to households as they remortgage will come. It's like there's not going to be a pinch point necessarily, and that's usually, in terms of housing market, pinch points are the things that we do not like in terms of crisis, and this does not look like one. So we're relatively comfortable that despite the fact that rates are getting less affordable and it's going to be a bit more expensive to borrow, this is still low by historic standards, but also this is not coming as a shock in the same way that the energy price cap increase that happened across the country, across the board in April, and it's going to happen again in October. Those are pinch points. The mortgage market likely does not have the same issue. Something else to note on this point is that the Bank of England has recently removed the affordability test for when they ask for a mortgage. So that means that whoever is offered a new mortgage is not anymore stress tested to a large amount on their interest rate in case the interest rate were to go up significantly, or and so that they couldn't afford their mortgages anymore. However, everyone that currently has a mortgage has been stress tested, and so ideally all those households should have some resilience to the increases that have happened in the last few months. If you can move to the next slide, please. So what does this mean for the market overall in terms of what has happened in terms of the demand? So you can see the dark green line. That's the line of how many approvals for mortgages that have been for house purchases. You can see in gray for this beamed thing that for whatever reason is going all the way to the top of the slide, but that signals the last UK recession, which is the pandemic. And during the pandemic, there were very few house purchases, but then has picked up again and was very high for a while. And that has now returned to normal. There are a number of ways to look at this chart. You can say house purchases with mortgages have returned to normal. Everything now is fine. You can also look at it looking at the trend in the last few months and look at this and say, this is falling quite quickly. So maybe demand is not as strong as it used to be just a few months ago. So I'm going to leave this to discuss to my colleague Imran that's going to look at the forward look. But what we can say here is that we are, by the looks of it, returning to normal level of remortgaging and normal levels of house purchases, which by all means seems to be a good thing. However, if we focus on the direction of travel, we're slightly more worried about where those number of transactions are going to go in the future. And if we go to the next slide, I believe we're moving to a rental. Yes. So we've talked about home ownership for a while, but we wanted to focus a bit on private rents too, because those are really private renters are really one of the segments of the market that are really between a rock and a hard place at the moment. There are a number of indices to look at private rents. None of them is perfect because they're just not as accurate as the actual transaction value that we have for home ownership, but we do what we can do. So this is one from the ONS, and it's an index of all rental properties. So this is not just the new rental properties, but this is tenancies that already exist and maybe have been going on for a few years. And so this is how much they have been increasing in price in the last few months. And you can see that the index for England, excluding London, has been going up quite a lot. But the one thing that I'd like you to focus is compare how much rents have been going up versus the wage growth in real terms. So that is how much money people have in their pocket after accounting for inflation. And wage growth in real terms has been going down. Fionnuala has touched upon it. That can be broken down further. So it's been going quite, it's quite not okay for some private sector workers, especially in the financial sector, much less so for public sector workers in the last 12 months. But the key thing is the difference between private rents that continue to increase and wages that do not keep up with inflation. That clearly at some point will catch up with renters and further impede their opportunity and chance to save for a deposit and get into the basically earlier five slides on my presentation, which are about home ownership. So letting aside whether mortgages are affordable or not affordable, this is one of the main drivers of the reason why private renters may find it more difficult to save in the following months, is the fact that earnings are not keeping up with inflation, and at the same time, increasing amounts of demand for rentals are making rents more expensive across the board, now even in London, but particularly outside of London. And if we can go to the next slide, we can see how much that has changed since the pandemic. So this is very helpfully, this is a Zoopla chart, and that just shows how much every month by every region in England, in the UK actually, rent has gone up. So the same on a monthly basis in the southwest, for example, rent is now £127 more expensive than it was in March 2020, and that is a rather significant amount after accounting for the increase in average monthly earnings. That is around 5% of the average monthly earnings, and that is a large increase in private rents in an environment that we know has now been also affected by rising increases in every other bill and utility. So this is just to give an idea. This is going across the board, and even though in places it looks like it's not particularly high, it's still a relatively high percentage of the growth in earnings. And so this really is one of the segments that we would like to focus on. This is one of the, when we say that we are not necessarily worried about the health of the housing market, there is, however, the caveat that we think that private rental sector right now and private renters are one of the segments of the population that may need more help during these months of crisis. And if we go in the next slide, I think we can see that from another point of view as well. We can see how private rents, as of now, the affordability of them changes quite a lot during across regions. This should be no surprise, really. But again, this is something else to kind of myth bust the idea that the South is particularly unaffordable, whereas the North is great and everything is cheap. And it's quite not the case. So when we look at just the average affordability, which is the dark purple dots, you can see that yes, that seems to be the trend of northernmost and Midlands places being more on the left-hand side and cheaper compared to income as a ratio to income, and the southern and London being more expensive. However, when we look at the distribution within every region, and that's the range of the bar, you can see that in many places in the North and in the Midlands, there are authorities and that where the local rents are higher than actually average rents in the southeast. That's Manchester, that's Nottingham. So the idea of having, and we are guilty of this to an extent, of having a distinction south versus Midlands and North doesn't quite apply to rents. It's much more of a city story, and it's also why a lot of investors are now looking to move away from build to rent just in London, and they're going to Manchester, they're going to Birmingham, they're going to other cities as well, other core cities as well, and that just for their perspective because the returns are there. And those markets are ready for it because the demand is just so much greater than supply, but also because there is appetite for that kind of tenure in those markets as well, and the returns would be particularly high as well. If you could go to the next slide, please. Very quickly, the proportion of income that is acceptable to spend on rent, there isn't, as in there is usually the rule of thumb is you should never spend more than a third of income on rent. As a person that lives in London, that's quite funny as a rule of thumb because that feels like a very low amount, but it changes quite a lot. That usually is described as affordability, but affordability is a very personal threshold. So usually that's described of what it is. So 30% of income, not more than that, should be spent on rent and housing costs in general. Lastly, moving on to development sector, this is a top tip from Homes England to you, which is where you want to look at what's going on in terms of how much gets built, and to have a very up to date figure of what actually is getting built across the country. Do not look at housing statistics. You have to look at energy performance certificates, especially the ones that are assigned to new build dwellings. And that's because they are just much quicker and more timely to be published than anything else. So this chart may need a bit of explaining. So in the horizontal line, you can see every week of the year. And so the lines just track how many new EPCs have been issued in every week of the year. And you can compare year on year if there have been weeks where there has been more activity or less activity. And you can see that in 2022, we're finally back on track to where 21 was, and you can't see the previous years, but also we're back on track with where previous years were as well, meaning that the market is broadly back to normal. There has been now as many EPC in 2022, roughly as many as there were in 2021. And that just shows that in general, the new build market is relatively healthy in terms of how it's performing right now. Their order books of developers are full, and they're quite confident for the next few months. The real question is, and this is a question for my colleague Imran in the future, is whether that is going to last in the future, whether these completions and this EPC that we're looking forward to as a proxy for completions are not going to drop. You may notice that the big drop in the light yellow one, that's clearly the first lockdown, and you may also notice the drop at the end of the year in December and January, because no one wants to actually move those during those weeks. Everyone's still hungover from Christmas. Can we go to the next slide, please? So we were saying we're not sure about whether in the future months that trend of going back to normal is going to last. And one of the reasons why we've touched upon with inflation is that inflation is hitting developers as well, and SMEs in particular. This is indices of cost for materials and labor, and you can see how much and how quickly they have gone up in recent months compared to what historically was quite a flat line. It's a very boring chart until you get serious pandemic-related disruption. But this just means that in the past 2 years, developers have really struggled to find materials, and they've had their supply chain severely disrupted. This is fine in an environment where house prices go up 10% year on year every year, but we don't think that necessarily is going to be the case. We've touched upon it. House prices are slowing. We do not expect house prices to remain a 10% increase year on year in the following years. And so the increase in price and prices that will become elevated will prove a problem for developers, especially smaller developers, so SMEs, and will impact on their viability. Something else that may impact on their viability clearly is anything else that will delay when they can recoup their fixed cost when they do get them, and some of it is planning. I just want to touch very quickly in the next slide of an issue that some areas of the country may have. There is a separate session on neutral neutrality, and I believe it's this Friday, and I'm not sure our colleagues in the Local Government Centre of Excellence will be able to confirm this, but there is another section that will cover this extensively. But I just want to show that this is a serious issue in some areas of the country. So as of now, there are some areas of the country where working on a planning permission and starting to build on site is severely hampered by the fact that those areas have been deemed as unsuitable for development because they have to maintain neutral neutrality. Again, there's a separate session. If you're interested, please do follow that. The one thing that we've done with our spatial team, though, is just to check how much of an impact this has when we consider areas that were already affected by other constraints, such as areas of outstanding national beauty, World Heritage sites, green belt. So if we account for those areas as well, how much more of the land of each individual local authority is affected by neutral neutrality. And you can see that this is a major issue in the Northeast. You can see that this, and parts of the Southeast especially, but for the purpose of this session, it's not much of an issue anywhere else in the Midlands and in the North. There are some cases of authorities where this is a sizable amount of land in the local authority. That's Buxton. But in general, it's more of it's very localized in certain areas, and it's a serious issue there because the housing market, the development market is basically like halt to a standstill. But then again, if you want to know more about this, there you go in the chat. Very good, amazing. By our powers combined. And can we go to the next slide for something else, like another top tip from Homes England, and then I'm going to be handing over to Imran. You may have noticed that the latest census has been published recently. We're very excited about this. It's it's better data. We did not want to keep using data from 2011. It was very annoying and very weird as well because many things have happened since 2011. There is an however. you may remember when you responded to that census. It wasn't any other year, and it wasn't any other month. It was during one of the lockdowns situations. And so the validity and the timing of the data just means that we just have to be a bit more careful in the way that we analyze the census. And the ONS is doing a fantastic job in putting things into context. However, you will see commentary and you will see analysis that may not necessarily have the same thoroughness that the ONS will have. And so, for example, we've already seen commentators just talking about the fact that household size have increased for the first time in decades in England, which is true. That's what the census tells us. So that's a sign that we definitely need to build increasingly more housing, which maybe is one one way to look at it. The other way, which is the opposing side of the same debate, will say that there are ever more empty dwellings in the appearing in the census as opposed to households. So there aren't enough households, and clearly both of them could be true. We just have to remember that this is very much of the time of when the census was run. So just remember, how many households do you think were quote unquote suppressed because people were living still? They had moved back to their parents. They weren't necessarily they hadn't necessarily picked up a job somewhere else, or they couldn't afford to go and move out by themselves during the pandemic. And so the data is relatively skewed. And so we just have to be careful. And the ONS will do an amazing job in the next few months in publishing this. But when we use this as an evidence base, just be mindful of when this was collected, because it may skew especially city center data, because we've seen cities recover much faster than the rest of the country from when the census was run in March 2021. I believe now we can move into a bit of an interactive part of the conversation. So if we go to the next slide, we're going to go through, we are going to ask you a couple of questions. At Homes England, we read the book Super Forecasters a few years ago, and we got a bit over our head thinking that we could do the same. So this is about asking a large amount of people independently their opinions about some topics, and then looking at what the wisdom of the crowd is on those topics. And we do this with colleagues on a regular basis. And not to boast, but our colleagues are very good at forecasting the future, but they don't know that they're forecasting the future because all of them are being asked individually. And we're going to try and do the same. And then we're going to compare your responses to what our colleagues think. And we have, I think, a couple of questions. I'm not sure who's helping me from the team at the back, but if we go to the next slide. There you go. So the first one is, how much do you think house prices have changed in your region? How much do you think they will change in the next 3 months? So they will decrease, they won't change, they will increase. When I say small change, it means small increase. But yeah, do let us know. And then we're going to compare it to the general sense of what our colleagues see happening. Oh, I can see small increase there. People are still bullish about this market. For people not very confident. They usually say we should wait 20 to 30 seconds. You don't realize how long 20 to 30 seconds is when you're on camera and you're supposed to not say much.
Mm-hmm. We've now got 207 responses, so I think that's a pretty good response rate. Can you see the responses in front of you?
I can. On average, I would say that our audience is positive. So the net balance of responses is positive, driven by the small increase in changes. Okay, that's fine. We'll compare with what we have later. Can we go to the next slide as well? We have another question. Yeah. So what do you think about the local economy? So not just the housing market and house prices, but what do you think about the actual economy? Are you as bullish about it? Much less bullish about this economy, aren't we? And Victoria, once we're happy with the response rate, I feel like we have the response that we get, which is the net balance. The net balance is relatively positive for apologies, relatively positive for the housing market, not that positive for the economy. We'll see what our colleagues think, actually, and we'll also show you the track record of our colleagues if we go to the next slide. Thank you. Oh, sorry, that was the other thing. So we can go to the next slide again. Brilliant. So your net balance for the housing market, you can see that it's positive, and you can see in dark green the net balance of our colleagues as well. When we ask them to tell the future, they're still positive about it, but their sentiment is decreasing, has been decreasing over time. And you can see, compared to the actual outturn of house prices in light green, that they've been very good at least telling us the direction of change of when things were to go up or down. And so when our colleagues tell us, oh, we think things are still positive, but they're going to slow down, that actually is a good indication of what we're seeing in forecasts and what we're seeing when we talk to partners, that maybe there is going to be a bit of a slowdown in terms of house prices, and this is going to cool off a bit, which is fine. It is, it's good to have validation about this. And in terms of the local economy, you are spot on with our colleagues as well. Maybe everyone reads too much news. It could be that, but everyone is very negative about this, and everyone expects the economy to not do very well in the next few months. However, and this is going to be, I think, a good segue for my colleague Imran, I don't think we're necessarily as negative as the majority of our colleagues or the majority of you in the audience today are about the economy. So there are challenges ahead, but hopefully they're not as big as we fear they are. So Imran, can I hand over to you for the next section? And thank you so much for your patience.
Thank you, Fran. So yes, we've seen what our partners think about the short-term outlook, as well as what the audience here thinks too. So what I'm going to do now is talk through kind of the forward look in a little bit more detail, kind of outline our view of the future, and kind of our approach to forecasting. So just a caveat, we're not psychics, despite what my colleagues may say about my metaphorical crystal ball. First, we're a delivery agency, so kind of when we look to the future, our focus is on kind of understanding what different scenarios, what different kind of risks means to us as a delivery agency. So, for our programs, our projects, and our aims and objectives. So what this means is that, whilst the numbers and the indicators are important, it's much more about kind of, what is the story of the future. That's kind of what's kind of really important and also really interesting. So that's what I'm going to focus on kind of in the next 5 to 10 minutes or so. So if we can go to the next slide, please. We've got, here's kind of the headlines of kind of the story of the future, according to, we get our forecasts from Oxford Economics, who are a internationally recognized consultancy and forecasting house. So this is kind of the story of their kind of central kind of base case forecasts. So, firstly, unfortunately, it is a bit of a gloomy outlook. Apologies for delivering, for ending on a little bit of a disappointing note, but it is a gloomy economic outlook. As Fridula described earlier at the outset, the global economic outlook has deteriorated and it's very uncertain. So certainly in the short term, growth will be sluggish. At the heart of this is high levels of inflation, with a peak of over 10% forecast by the end of the year, but it will fall away sharply, in the next 2 to 3 years. Kind of the other key headline is the hit to cost of living. We've heard in the media about the cost of living crisis, and it's not going to get easier, certainly in the short term. The labour market, on the other hand, has been relatively strong, and that is forecast to continue. And then in terms of the housing markets, expecting it to cool significantly, kind of as demand falls, with a slight correction in prices in 2024, and then a subsequent slowdown in supply too. And then, generally, with an uncertain outlook, there are many risks on the horizon. To us, a prolonged and more severe conflict in Ukraine is probably the key risk to the macroeconomic environment. And I'll talk through later our approach to kind of dealing with that. So if you move on to the next slide, please, I'm just going to talk through some of these measures in a little bit more detail. So firstly, there's a gloomy economic outlook. Growth is going to be sluggish. We can see here on the left-hand side, which shows kind of average annual kind of growth rates in GDP, and it's going to average less than 2% from now until 2027. So that's lower than what we previously expected, because of the deteriorated economic outlook. So even if we look at forecasts back in April, we expected, certainly next year, we expected growth of over 2%, whereas now we're just expecting growth of 1.3% next year. So, it'll be lower than what we previously expected. It's going to be low by historic standards. It averaged 2% between 2015 and 2020, and we're now to 2027. We're expecting less than 2% growth. And then it's also going to be low by international standards as well. So we can see here on the right-hand side, we have kind of annual growth rates for other countries over the next 2 years, and we can see kind of where the UK lags behind the majority of major countries, as well as kind of Eurozone and world averages as well. So if you move on to the next slide, please. Now we've got all the headlines have been about inflation and rightly so. And I suppose there's a mix here of kind of good and bad news regarding inflation. So firstly, start with the bad news is that they will continue to rise, and we can see this on the left-hand side, peaking to over 10% by the end, before the end of the year. There's a few reasons for that. One of them is the kind of the further rise in the regulatory price cap, plus continued increases in kind of fuel and food prices as well. But then also, as Fionnuala mentioned earlier, inflation expectations are a big driver of inflation. And there's growing evidence that the public are expecting consistently high inflation. So there's some of the reasons why we think it's we're forecasting it's still going to rise before falling away. And that's the good news. And we can see on the left hand side the inflation levels falling away relatively quickly as the fuel shock from this year kind of falls out of the calculation. So that's some good news. The bad news is that despite this, the UK will continue to have one of the highest levels of inflation amongst major economies. We can see here the chart on the right hand side, which compares kind of inflation forecasts to select other areas. And you can see kind of both kind of certainly kind of in the US and across Europe, inflation would have already begun to fall well into kind of by the end of this year, and falling from a lower peak as well. So why are we forecasting it to be higher in the UK and to fall away at kind of a slower rate? Well, there are a couple of reasons. One is our dependency on kind of external energy supplies. The second point is the energy price cap has kind of created a longer gap between higher gas prices and the pass through to consumer prices. So that's why kind of we're it's sustaining in the UK a little bit longer. And then the third point is also kind of the tight labour market and possible kind of greater wage pressures could play more of a role in sustaining price growth versus these other areas. So they're kind of some of the reasons why we think inflation is going to be higher in the UK and for longer than kind of other areas. So if we move on to the next slide, please. It's here we're talking about interest rates, and Fionnuala covered in a lot of detail kind of the story here, which is about kind of the dilemma between needing to contain inflation without kind of crushing economic recovery. So it's all about kind of finding the right balance here. The other difficulty here is that the nature of the inflation we've had, which has been driven by a supply side shock, means increasing interest rates are to an extent a bit of a blunt tool to combat inflation compared to kind of ordinary kind of demand side driven inflation. So here, that's why kind of we're forecasting here a relatively low peak of 2% interest rate before settling at 1.75% throughout the rest of the forecast period as inflation falls. If we move on to the next slide, please. One of the key headlines has been around the biggest, about household incomes. And we are forecasting the biggest squeeze to incomes in 80 years. So around a 4% fall in real income by the end of kind of 2022, 2023, and then real income growth of just 1.4% per year until 2027. So real growth refers to growth after adjusting for inflation. So that's shown kind of on the left hand side. We can see kind of the mustard coloured line as kind of the real levels of household income growth. And then on the right hand side, we can see kind of the breakdown of this. You can see kind of the main drivers being kind of price inflation and then recent changes regarding kind of tax and national income contributions. So we can see, it is a cost of living crisis, but it's not just all about inflation. wage growth, which is kind of the purple section on the chart, is a key component. And you can see kind of from 2022 to 2023 and 24 how that purple bar kind of shrinks, and that's representing sluggish wage growth. And that's not a new phenomenon. It's been sluggish since 2007. If you're interested, the Resolution Foundation and the Institute for Fiscal Studies have done loads of kind of great research on this. And what I think one of the key kind of pieces of analysis that I saw yesterday suggests that if wages had risen from 2007 based on the previous growth rate before 2007, wages would have been around £8,000 higher than they are now. So that's just kind of some illustration that, yes, inflation is playing a key part, but there is this idea of sluggish wage growth, which is not something new to the economy. If we move on to the next slide, please. Just quickly on labour markets. This is, the chart is relatively kind of uninteresting. It's certainly in terms of forecasted to remain stable at close to around 3.8% throughout the forecast period. The key story here is more around the nature of the labour market and kind of, where, how we work, where we work, kind of how long we work for. It's all about kind of, the future of work, which we don't necessarily have forecasts for, but there's lots of research and kind of anecdotal publications on kind of the changing nature of work. But certainly in terms of kind of headline terms, it's forecast to be fairly stable. If we move on to the next slide, please, we're now going onto the housing market. And the key headline here is we're expecting the market to cool down. So what does that mean? So we've got two charts here to kind of illustrate a kind of slowdown in demand. So firstly, on the left-hand side, we have prices. Forecast to still be quite strong this year. Growth of 9.8% by the end of the year. But by next year, it's going to fall to growth of just 0.5% in 2023, and then a 2% fall in 2024. So we are expecting a small correction in prices in 2024. And then, for the rest of the period, average growth rate of just around 3% per year. So that's kind of what we're expecting in terms of prices, while still being strong this year, a correction in 2024, and then kind of much more kind of lower levels of growth. On the right-hand side, we have forecasts for residential transactions. They're going to falling by 17% by the end of the year, and then kind of settling at around 1.4 million transactions per annum, and that's fairly stable, but lower than what we've seen certainly over the past 2 years, but much more kind of in line with kind of historical averages. So why are we expecting this cool down in the housing market in terms of demands? Well, there's three things. There's squeezed household incomes, there's higher interest rates, and then there's also kind of transactions that have been brought forward. So people have brought forward transactions over the past few years, so they would have ordinarily occurred in future years, but they've been brought forward. So that's kind of why we're forecasting that. I think it's fair to say we wouldn't kind of characterize this as a housing market crash. Despite rising interest rates, distressed sales and defaults are unlikely to drag on the market due to the robust labour market. Owner occupiers being in a much more comfortable position. And then kind of 80% of all mortgages, being on fixed rates. So if we move on to the next slide, please. Just quickly on rents. Again, it's a similar story to house prices. We're expecting a cool down, but certainly kind of at a lesser rate compared to house prices. That's kind of the rationale here, and that's because we're still seeing kind of continued demand for rental properties, especially in urban centres as well. So on to the next slide, just looking at housing supply. This is the other side of the cooling of the market. So here we have forecasts for housing starts, and again we're expecting it to after certainly kind of an increase in activity over the past 3 years, kind of leveling off, predominantly due to kind of supply issues and potential risks, but also kind of expectations of lower demand as well. So we'll start to see that feed into housing supply. If we move on to the next slide, I just want to quickly, before we go into Q&A, just start to touch on risks. So that's that was the story of our kind of central scenario, central outlook. But as always with forecasts, and even more so now with kind of an uncertain environment. There are a load of macroeconomic risks, and there's a high degree of uncertainty. So the chart on the left, that shows the results of a survey done by Oxford Economics of their kind of users and clients around the world. It shows what they consider to be kind of the key short-term risks. And we can see the highest is around kind of a more severe and protracted conflict in Ukraine, and then also around kind of different issues around kind of inflation and monetary policy. So those are the risks. And then on the right-hand side, these risks have been translated into a series of economic scenarios. And then this is our kind of preferred approach in the agency to manage risk. It's to select 2 of these scenarios in addition to our central scenario, and kind of model those going forward and use them to test our programs and our projects and our portfolio. So at the moment, we consider the most appropriate downside scenario to account for risk is the severe war scenario. The upside scenario is very remote, and it's speaking frankly quite unlikely. So we've still included it for business planning purposes, but I'm not going to talk through that today. Just on my final slide, I'm just going to talk through a quick snapshot of the downside scenario. So if you move on to the next slide, please. Here's just here's a snapshot of the downside scenario compared to the central outlook. So under this scenario, the conflict in Ukraine lasts well into 2023. There's further sanctions imposed upon Russia, which leads to kind of further restrictions in energy supplies, which leads to further energy price rises and food shortages. So the impact of that, the implications of that is if we start with the chart on the top right hand side, it's higher and more sustained inflation, so peaking at 14% rather than 10%, and then inflation lasting well into 2024 as well. On the moving to the top left, we have similar levels of GDP growth, but the longer conflict causes the UK to fall into recession in 2023 with a contraction of GDP of 1.2%. Unemployment is forecast to be higher, over 5% as the recession hits the labour market. And the implication of this on the housing market is that higher unemployment, reduced incomes and low confidence causes a house price crash to fall, with house prices to fall in 3 consecutive years until 2025. So where will we end up? The longer the war goes on, the more we're likely to drift towards the downside scenario, which is kind of the yellow line. We'll probably end up somewhere between the two, but again, it's a constantly moving picture, and it's difficult to say. So if we move on just to the next slide, I appreciate we've covered a fair bit of ground today, but just our kind of concluding points from each of the 3 sections. So in the macro view, we've had kind of inflation, global challenges, domestic political uncertainty, meaning things in the short term will deteriorate before they get better. In the housing market, by contrast, and considering all the challenges, it's in relatively good health. Majority of existing homeowners are sheltered from the risk of a crash, but renters, and particularly those at low income levels, are exposed. And then, on the economic forecasts, they are gloomy, especially in the short term. And the biggest risk is a prolonged war in Ukraine, in our view. So that was just thank you for listening. A quick summary of what we've covered. I'm now going to hand over, I think, to Victoria for Q&A.
Brilliant. Thank you so much, Imran. Could we go on to the next slide, please? So I'm stepping in for Rory because he's having network problems. But we're going to just probably have time for one question. Lots of questions were placed in the chat, which is wonderful. And I think the team's done a really good job at answering most of them. But one question that's just come in, which I think will be of interest to a lot of people. I'm going to put this to Fran, and then anyone else can step in afterwards if you've got anything further to add. Has Brexit been a reason in the UK experiencing higher inflation and lower growth compared to other nations? Over to you, Fran.
Thank you. And that is a $1 million question, but I actually have the answer for this. So please do send the money to my address later. And the answer is no. So inflation has been really a global issue at the moment. And Fionnuala has touched on it, and it's mostly due to supply chains and China's COVID policy and the war in Ukraine. However, and I won't let you down if you want to necessarily blame Brexit for something, because any political instability causes problems to the economy. Brexit has been, and you if you go back, or if you look at the recording again, we had a chart on business investment, and you can see business investment in the UK just plateauing and then falling after 2016. So that's not strictly Brexit, but a major political decision was made in mid 2016, and business investment kind of stopped since then. So not responsible for inflation, but in general for the economic environment and the political environment, yes.
Okay, great. That was extremely succinct. So we might have time just for one more.
Amazing.
This is one of the really early questions that came in. If high public sector pay rises risk fueling inflation, surely significant rises in pensions will have the same effect. And again, Fran, would you like to take us through that one? And then Fionnuala and Imran might be able to come in. You'll have to do it in a minute.
Sure. Very quickly. So any in terms of the wage price spiral, any increase may cause inflation, yes. However, something to keep in mind is that UK pensions are incredibly low by international standards, because when we talk about pensions, we only talk about the up to £9,000 a year, and that is the part that is protected by a triple lock. So increasing that, even if we increase that by inflation, that is only really £900, £1,000 per year increase. On the other hand, public sector pay is much higher for everyone. Like, there are people that are paid probably £9,000 a year, although that would be part-time workers, but the majority are paid more. And so the impact of public sector workers receiving an above inflation pay rise is much higher on inflation, if we think that there is going to be the risk of a price inflation spiral. In terms of whether this is a political decision, every decision is political. So I'm not the one to decide if that is or not. But the pension in particular they're just like a much smaller pot of money.
Expertly answered. Thank you so much. Okay, so this is our email address. This is the Local Government Capacity Centre email address. Do email us if you have any further questions, you'd like to share your thoughts on what more we could do to support local government capacity, skills and knowledge. So I'll now say thank you so much for joining us this afternoon. Thank you to Imran, Francesco and Fionnuala. And I see someone's got their hand up. We're not speaking to people during the session, but email us and we'll try and answer any questions you've got. Okay, thank you. Goodbye.